F3, and I didn't have time to go to any questions, but I'll prepare some questions and send it to you. But let's look at the subject. But we are going to look at it, debt finance today. Yeah. So.
Okay. No, but we know we had questions last time we didn't do.
All right.
Go through them today. I don't know if you remember.
Right. Yeah. There are questions. No. Shall we do it next time, because I didn't go through that one.
Okay.
Yeah, we'll do it next time. Yeah, I forgot about it, but I will go through the thing and we will do it next time. So we will have a fair amount of questions for the next time. But let's start off straight away with the subject, which is a fairly deep subject, which is going to be the debt capital.
Okay.
Right. So we know the company, as far as the financing strategy is concerned, there are two main sources of funding. One is the share capital money, the other one is the debt capital money. And we are going to look at debt capital first, and later on we will look at the equity capital also. So as a strategy, we will be using debt capital. And what is debt finance? Now that is what I am going to talk about. What is debt finance? So debt finance is the loan funds. That is the loan funds to a business. Once you give a loan to a company, you can be a lender. One thing is the difference between a lender and an equity shareholder. Lender does not have any ownership rights.
Okay, yeah.
He doesn't have any ownership rights. Equity shareholder, even it may be 50 shares, still you are owner of the company. And generally the lending, as far as the companies, yeah. Yes, I do.
Okay.
Yeah.
So yes, now so debt finance. So basically, they have no ownership on the company.
They have no ownership. They are never the owners. They are never the owner. But the shareholders, so the equity funding, they are the owners. It may be small 100 shares, but still you are an owner, a little bit of owner. But you may give $10 million to the company, but still you don't have any ownership rights. So the ownership is with the equity holders. And in the financial strategy, it's an arm's length transaction, arm's length relationship. That means, if your father gives a loan, that is really not debt capital.
Right? Hello, I lost.
Yeah, hello.
I lost you there.
Hello. Yeah, but I'm trying to say hello. Can you hear me? Hello.
Okay.
Yeah. Can you hear me?
Yeah, I missed a lot of.
Okay, no, don't worry.
I can hear you now. Yes.
Right. Okay. Basically, what I said about the debt is an arm's length transaction. That means it is a relationship between two equally knowledgeable people, and they come to the transaction with full knowledge of rights and obligations. Right. So if your father gives a loan to your business, it may not rank as a debt finance, because he is giving not as an arm's length transaction, probably because he is your daughter. Right. So that is what it has to be, an arm's length transaction. It's a business transaction, and the return that we pay is called interest. And you remember, on equity, what is the return we pay? Dividends. On equity we pay dividends. And on the loans we pay the return, we call it interest. And interest is always paid out of pre-tax profits. You remember, we have your revenue, we have cost of sales, we have gross profit, then we have admin expenses, then we get what we call operational profit, then we pay the finance charges, and then we have a profit before tax, and then we have the income tax, and then profit after tax.
Yeah.
And dividend is paid out of profit after tax. So dividend is not tax deductible, whereas the interest is tax deductible. And therefore it is considered as an expenditure. Dividend is never an expenditure. Dividend is never an expenditure. Interest is an expenditure. Dividend is you are distributing profits out of profit. And therefore the main important thing is that that's correct. Because the main important thing is that the main purpose why the people go is it is tax deductible. And from the company's point of view, it has a risk. The board of directors, they have a risk. if interest are not payment and if the capital payments are not made, the lenders can take you to courts. Whereas the shareholders can't take you to courts because the shareholder is basically a lender. Shareholder is the owner. Shareholder is the owner. Correct? So that's a difference. Shareholder is the owner, lender is a lender, and because of that there's a risk to the board. So that's what I told you some time back also. Most of the directors may be reluctant to go for loans because they have a risk. If they don't pay, they can be taken to court.
Yeah.
Right. So the next one, what we are going to look at is the security. Whenever the lenders give money, particularly the banks, they will ask you for some security, some kind of collateral. Now shareholders, they will not ask you anything because the shareholders are owners. So they give money without any security. Yeah. But the lenders will ask for security. So the lender will normally request some form of security. And generally, the security is there for one purpose. If the lender defaults, if the borrower defaults, the lender can take assets, the control of the asset. So that is why, say, if you are going to take a loan from the bank, mortgage is the house. If you default, they can come and take your house. That is what happens. So there are two kinds of security. One, what we call the fixed charge. Fixed charge is primarily something like a mortgage. It is on a particular asset. So mostly it is given for buildings, right? Mostly it is given for land and buildings. It is a security that, you know, in the event the company goes for liquidation or anything, the whoever who has that kind of a security is right in front of the queue. They have the priority ranking to get their money back. Right? So that is what we call a fixed security charge. So it's like a mortgage kind of a thing. Then the other one is what we call a floating charge. Floating charge is again the general assets like inventory, like receivables, the assets which can change over a period. That is given as a security, right? There you rank priority, but surely not as number one in the queue with a fixed charge. Still, you will have some kind of a preferred creditor, but not so strong as a fixed charge person. Fixed charge man will stand always number one. And then maybe you are standing number two. Yeah. People who don't have any security will be standing in the queue as number 100. So generally the things like inventory, receivables are the things what we give as fixed charges or the floating charges. So that's the kind of security. So your examiner may ask this question. You may know two kinds of security we can give, fixed and the floating. So the preferred creditors means they are in the higher list of the creditors than otherwise. So the number one fixed, the creditor in the list will be the fixed charge one, then the floating charge people, then the other people will stand behind the queue. They will not have any priority. Right. So now, debt covenants. We spoke little about the debt covenants when you are working the formulation of financial strategy. What is a debt covenant? Now you can see it's like an agreement. It's an agreement. Basically, as the picture shows, it ties your hands. It ties your hands. Your hands are really tied up once you get into a debt covenant. Debt covenant is basically an agreement with your lenders. Right? So, lenders, how they minimize their risk is, one, by taking security, the fixed charge or a floating charge. And then the other thing is through covenants, through various conditions. So one of the conditions will be dividend restrictions. They will say they can't pay a dividend unless the company's cash flows are X amount. They might talk about financial ratios. Particularly, they might say the interest cover should be, remember we discussed the interest cover, should be 1:10. They might talk about the gearing. The gearing. And they might say the gearing should not exceed 40%. the another one, the other day when we were talking about the ratios, one ratio or one term which I want to introduce is this EBITDA. What is that? EBITDA. What is that? EBITDA. That is earnings before interest, tax, depreciation and amortization. Earnings before interest, tax, depreciation and amortization. Earnings before interest, tax, depreciation and amortization. So that, because obviously when you show that figure, it's a higher figure, because after charging depreciation, after charging interest, after charging tax, the figure you may get is 40 million. But when you say earnings before interest, tax and amortization, it may be about 100 million. So some people don't like this figure because they say it is, they call it EBB, earnings before bad bits. Earnings before bad bits, that is before putting the bad. But there's an argument saying it is a good measure because the depreciation, amortization, all are book entries. I mean, it has no impact on the cash flow. So because of that, some people think it's right to measure earnings before. So it's another new thing, not a new thing, but it is now recent, it is getting developed. So remember that one. Then another way how the companies are monitored is through the financial report. The debt covenant might say 6 weeks after the end of the financial year, the audited financial statement should be provided. So you can't delay, you can't avoid giving the financial statements. You are compelled to give the financial statement. Then another restriction they might put is you can't issue any further dates. Further dates. That is already, if you are going to go for new dates, you must get their permission, kind of a thing. However, they might allow certain dates which are below their ranking. Now say if you are a preferred creditor and if you are going to issue me unsecured money, then it is not going to affect my rights too much. So in that case, that is what we call a subordinate debt. Subordinate debt. That is you have given money on a mortgage, but now I want to raise some more money without giving a mortgage. So in that case, you might not object because your priority, your ranking is not affected. Right? Okay. So these are some of the debt covenants that can bring you an impact upon your company, and probably that can give a control to the lender. So you can see when you borrow money, lot of conditions. Lot of conditions to make. Not an easy thing. Yeah, sorry.
Yeah, one question.
Yeah.
Question. Can the subordinate debt? Can you explain that again?
Yeah. Now that is, imagine you have given me a loan and you have taken a mortgage, or you have given me a fixed charge. Now I want to take another loan. You will not allow me to get the loan on a fixed charge. Right, because if you get it on a fixed charge, you and the other lender becomes equal. But say now you have a fixed security, you have a mortgage on the thing. You will not allow him to give another mortgage on that same building. But I'm going to raise a loan without giving any security. In that case, you are not affected. That is what we call a subordinated debt. Debts ranking below the existing unsecured. Right? You are an unsecured creditor. You don't have any mortgage. But now I'm going to raise a loan which is not going to affect your priority. So in that case, you are not worried about taking a loan. But you will be worried if I'm also going to be in the same scenario. So then the covenants can be negative covenants or can be positive covenants. What is a negative covenant? Negative covenants is basically the covenant will say don't do this, don't do this, don't do this. So it basically says what the borrower cannot do. So cannot take any additional loan, for example. Right? A negative covenant. Cannot pay cash dividend exceeding a certain amount. Cannot sell certain assets. So before you sell certain assets, you must inform the lender. Cannot enter into certain type of leases. So you can't take big leases. Cannot combine in any way with another firm. You can't go for a takeover or merger. Cannot compensate or increase salaries of certain employees, particularly the directors. They may say director salaries cannot be increased until their loans are paid over commitment or without their permission. So all no's. So that is what we call negative debt covenant. Then on the other side, you can have positive debt covenant, where the lender will say you must do these things. You must do these things. So maintain certain financial minimum ratio. So the GP ratio should be 25%. Gearing should not exceed 40%. So you have to comply with those. Maintain account records complying with the generally accepted accounting principle. That is, your financial statement should comply with the international accounting standard. Provide audited financial statements within a specified time period. Perform regular maintenance of asset used as a security. So if you are given a building, they might ask you to see that it is properly maintained, and even to get a insurance cover. Maintain all facilities in good condition. So your machines, everything should be maintained. Maintain insurance policies on property. So whatever the property that you are given, they might ask you to take insurance cover against fire and everything. Maintain life insurance against key employee. So people like the CEO and all that. So if something happens, at least the company will get some money for that kind of people. Pay taxes and other liabilities when due. Right? So if you don't pay taxes because the taxes becomes priority, so they will insist that you pay taxes. So these are what we call positive debt covenant. Then what is the impact of covenant? When you have a covenant, what is the impact? Is it a good thing or a bad thing? So the impact is definitely good for both the lender and the borrower. Sure, it is good for the lender, no question. Right? It protects the lender. It protects the lender. It gives that protection. But even to the borrower, it is a kind of a discipline. Now, my company, I have seen, because of the covenants, we are restricted in doing certain things. So because of that, it brings some kind of a discipline. Because the gearing, you can't exceed it. So when you do that kind of a thing, you probably will get a higher credit rating, and that should be beneficial to the borrower. So don't think covenants are a bad thing. Covenants are a good thing for both the lender and the borrower. And generally, the covenants are not there to put a burden on the borrower. I mean, it should not be something restricting you. It is not something that is going to be a real trouble for you. It should be for your good. So I remember one time I was working in a company, and I had taken some loans from a particular bank, and that bank manager or that chief executive of the bank was too harsh on us. He was not allowing us to pay management fees. He was not allowing us to pay director's fees. He was not allowing us to buy even a car. So he was putting lot of conditions, and that was too restrictive, I thought. It should not be done in a way that is the bank, because the banks are not running the company. We are running our company. So we should be allowed to give that thing. The bank should be monitoring, but don't try to get too much of involvement. Don't try to be a mother-in-law, I would say. Don't try to be a mother-in-law and trying to interfere. Right? Look after your son, it's all right, but don't try to be a pest kind of a person. So debt covenant should not be that one. So that is what a debt covenant is. So the impact is, it's a good impact for both sides. So what happens when you breach the covenant? Now when you breach the covenant, that is only you will see this fellow coming out of water. The banks will not do anything for you till you keep up the covenant. But the moment you come out, the fellow will come out of the water. So when the covenants are breached, if you breach the covenant, there are a lot of responses they can give. They can still allow the company to continue. Okay, you are breaking the covenant, but we have confidence in the directors. You carry on. That is one way. Good people will do, good bankers. They might put additional constraint. So when they are not paying, they might say, we want a director's personal guarantees or additional mortgages. they might put require penalty payment. Okay, you have broken the contract, so the interest rate will be another 3% penalty. Additional increase interest rate, right? We demand immediate payment of the loan. You have breached the contract, so we are not going to give you 5 years to pay. Pay today. Pay today. So because the moment you breach, you are on the default. They can dictate terms to you. That is why I say this fellow will come out of water and try to dictate terms to us. So long as we maintain the covenants and pay them, they will be underwater. That is why in the Mendelow's matrix you would have seen the lenders come under high power, low interest. High power, low interest. They are not the people. They are not the people who will come and intervene. But the moment you breach, this fellow will come out of water and will try to swallow you.
Yeah.
Right. So that's why I always say the banks are there to give you a umbrella when there is sunshine. When the rain comes, they will withdraw the umbrella. They might ask you to. Yeah, that is always the case with the bankers. They will give you the umbrella when there is sunshine. When the rain comes, when you are getting wet, they will say, "Hey, Setu, I want my umbrella back." Yeah, I have gone to. I have gone through this situation with the banks. I was doing a big job one time, and they were giving me facilities one after the other. Suddenly, I lost the job, and next day, call come in, "Hey, Kumar, can you settle all the money?" That is how the banks are. Yeah, they are always like that. So whenever we are in trouble, they will ask for the immediate payment. They might ask increased security. They will ask for another additional mortgage, another additional collateral. Right? They might terminate the agreement. They will say that you are defaulted and the agreement is cancelled and we want money back. They might enforce the security, right? Because you are given a mortgage, they might say we are going to enforce it. We are going to sell the property and recover the money. So breaching a covenant is a very, very dangerous thing. Not a thing what you should be doing, but sometimes you are compelled to do it and it can have problems. So the way to minimize is not to breach the covenant, and if you are going to breach it, you must negotiate and try to to continue the loan without having too much of a damage. Right. The types of debt finance. There are basically two types of debt finance. One is the bank finance. Right? The company that is not listed in the stock exchange, this is the only source of funding they have. The debt capital, I mean. They can only go to the bank and get the money. But the company that is in the capital market, if listed, they can go to the stock exchange and they can raise what they call bonds. So they can go to the thing. It's again no ownership. It's loans, but the bonds. So the large companies could borrow from merchant banks. Small companies can borrow from the commercial banks, and the terms and conditions will depend on the amount you want, your credit rating, security of it, and duration. The theory is higher the risk, higher the interest rate. Higher the risk, higher the interest. So if you are not going to give any security, they will put a higher interest rate. If you are giving security and if your credit rating is good, they might consider giving you at lower rates. So that's how the banks will work it out. Yeah, right. So so we now the small yeah.
Small companies will get their debts from local banks, right?
They have to get it from the local bank. They have to get it from the big companies. They can go to merchant banks, and even they can go to the international banks and borrow in bond marketing and all that. So that is why the rich people they can enjoy everything, not you and me. So criteria to select type of debt. So most companies can borrow from banks. Right? Most of the companies can borrow from banks. But most of the companies consider bank borrowing as somewhat restrictive and somewhat expensive compared to taking money on bond. And therefore, the big companies will go for bonds. So, the factors that need to be considered are the liquidity, time scale, and the cost. Because the bonds, generally, it's for a long period. So if you're looking for short-term funds, the bond may not be the ideal one. Liquidity. Liquidity is whether there's money available in the market, right? If the market is doing very well, you can issue a bond and collect money. But otherwise, you may want to go to a bank. But you remember in 2007, 2008, the banks were having problems. They could not give money. The credit crunch came. So that also could be. And the cost, generally the bank finance is more costly than the debt finance, the bond finance.
Yeah.
So you have to consider many factors. So I'm going to consider in more detail the factor that we are going to consider. So normally, any investment projects, right? Any investment projects, the companies can use bonds and bank borrowings either way. And the funding availability may be for a short term, maybe for a long term. The funds may be available for infrastructure development, corporate expansion, or working capital. Right? The bonds are meant to be long term. Generally, the bonds are long to be main term, but the bank finance is more short term, medium term. So if you are looking for long term funds, 10 years, 15 years, ideal situation is the bonds. But if you are looking for 3 years, 5 years, go to the bank. Right? So in the recent year, many people have shifted their attention to the bond market because the overall cost is lower. And the flexibility, because the banks put lot of covenants. The bonds will not put any covenants, no restrictions on you. You can do whatever you want, it's so long as you pay the interest. So because of that, most of the finance nowadays they prefer bond. So it all depends. Ultimately, it will depend whether you have access to the bonds or not. So access is available only if you are a listed company. If it is listed only, you can go for bonds. So you have to look at whether you are a listed company. If the unseen or the OT says it's not a listed company, then the bonds is out for you. Right? So the bank finance may be open for many entities, but the capital market is very restrictive. It may be not available for every company, and for small companies, it may be very costly exercise to get the listing and everything. So I'm considering more details. So generally small and medium enterprises, what they call SMEs, they use bank borrowings because they simply can't go to the market. Right? Bank generally allows the bank, if you take a loan for 5 years, if you have money, you can settle it even in 3 years time. Right? So you can settle it in advance. So maybe with a little bit of a negotiation, you can do it. And the banks, they can change the terms at any time. They can increase the interest rate, they can reduce the interest rate, they can do it. But of course, I have option. If I'm good as a customer, if my bank is asking extra 1%, I can go to another bank. So I remember I was working in a company. And the one bank was giving me too much of problems. I shifted the account to another bank because there are many banks who are competing for it. But to go to the bond market, you have to build up a reputation. Banks, it is basically your relationship with the banks. But the bond markets, it is you are going to the public, so you must be very, very highly reputed. If you are not reputed, if you are not known, the bonds you may not be very successful. And you have to communicate your credit quality, right? The credit rating, how good you are, and that will decide the interest rate. If you are a high quality credit customer company, your coupon rate, the interest rate will be lower. But if you are not a high quality credit customer, your interest rate will be higher. And generally, the bonds have very standardized terms and conditions, not like the bank. Not like the banks. It says that it is there for 10 years, 15 years, whatever it may be. So furthermore to consider, whatever the way you raise, whether you want to raise money from bonds or banks, there's operational cost. You have to prepare your feasibility reports, evaluations, everything. There is something called operational cost. Entering the bond market will be a very difficult one for a new company particularly, and could be very expensive. But once you enter, the cost is going to be very significantly reduced compared to the bank borrowing once you are in the market. But enter in the market, it's like a barrier. The moment you break the barrier, you are okay. So, the new Prime Minister we have appointed to the country, he's a very intelligent man, excellent man with economics and everything. But he's not a very popular guy, in the sense, not a man, who has a charismatic kind of a character, who will smile with everyone and who will, tap at you and all that kind of a thing. So to bring him to an election is a very difficult thing. But I always thought, if you can put him on the chair, he will do a good job to the country. So we have been able to do that one, because what the country did was country elected the president, and the president has appointed this man as the prime minister, because I don't think he can ever come to an election. He is not one of those popular guys who is going to smile at every fellow. So it's the same thing. Entering is difficult, but once you enter, you will do a job. So similarly, enter in the market is difficult, but if you can enter, your costs are going to get reduced. Right? Because the lending agreement is based on very standard terms. So it is not going to change from one customer to the other customer. It is going to be very, very standardized, because when you pass that barrier, when you enter, you are somebody. Right? You are somebody. So because you are somebody, you are entitled for the privileges of that somebody. Right. So borrowing from bank basically implies that you have to submit to their terms and conditions, and sometimes you are dealing with uncertain conditions, where the banks might say interest rates will be reviewed every 6 months. Bank might say your loan will be subject to review after annual accounts or something like that. So you are always under some kind of a restriction line. Now we come to the money market borrowing. What is money market borrowing? Right? Money market borrowing. So money market borrowing, it is basically, you get this financial institution. It's a market. You want to borrow, I want to lend it. So there are dealers in money, right? The financial institution and dealers in money. So you want to borrow, I want to lend it. So I want to borrow it for few days, and you are there in the market to lend it for me. So it can be several days, it can be 1 year. So normally money market borrowing goes up to maximum of about 1 year. Right? So if you contrast that with capital market, now I want you to differentiate between money market and capital market. Capital market is long-term funding. Money market is short-term funding, from several days to a maximum of 1 year. So mostly money marketing businesses, mostly interbanks, because every day the banks will have to borrow some money from another bank to clear up their transaction. And most of the money market transactions are based on interbank. It is so it's essentially a 1 day bank, a 1 day borrowing, 2 days borrowing. But large profit making companies will be able to borrow or lend money on the money market. So remember, money market is essentially a short term market, whereas the capital market is essentially a long term funding market. So these are good questions that you can have it on the OT. Then we have something called revolving credit facilities, RCF. It's like overdraft. You have set up a limit, a maximum limit, and in that limit, as the picture shows, you can reward. Right? You can reward. So you have a limit. So you can withdraw up to the limit. So you have a limit of 100,000. Right? So today you have borrowed 20,000. So you have another 80,000 to borrow. You can borrow it. Next day you can borrow another 10,000. So then another 70,000 available. Next day you can borrow another 10,000. 60,000 available. Next day you deposit 20,000. So then your borrowing goes up to another 80,000. Within that 100,000 you can deposit. The advantage is your interest is paid only on the amount that you have borrowed for that particular day.
Yeah.
Now loan, if you take a loan, whether you utilize the loan or not, you have to pay interest on the entire loan. But RCF, it is only on the basis of utilization. So you may not utilize. It's like overdraft. So because of that, the amount borrowed will fluctuate over time, and it will be never more than what the company needs. Most of the time, the RCFs are offered by one bank, but sometimes it can be a consortium. If it's the amount involved is big amount, maybe a couple of banks will get together and give you the loan, because that bank will reduce the risk. Rather than one bank taking the entire risk, you want $10 million, so they will get 5 banks and give you a revolving credit facility of 10 million, but 5 banks will fund it. So the risk is now shared. Risk is shared.
Yeah.
So that is how the banks will try to minimize the risk. So money markets, revolving credit facilities, and then we have the capital market. Capital markets, as I said, it is basically essentially long term. So the bonds are issued by the lender. The lender will, the borrower will issue the bond. Right? So depending on the terms of the agreement, you have to pay interest. In the bonds, the interest is called the coupon rate. Coupon rate. So when the examiner talks about coupon rate, don't get worried. It is the interest on bonds.
Okay.
Right? So they will say coupon rate every 6 months 3%. So you have to pay every 6 months 3%. And you have to pay the repayment principal at a later date. Maybe they say it is after 15 years, after 5 years, after 10 years. So it's a formal contract to repay borrowed money with interest at fixed interval. So if you don't pay, you can be taken to court. So it is like a loan. It is like a loan. Right? The issuer is called the borrower and the holder is the lender. Right? I want to borrow money, so I issue bonds, and you are giving me money, you become the holder of the bond.
Oh.
Right?
So the issuer is the borrower.
Issuer the borrower. Now you are a company, you want to borrow money. So you issue bonds. So that it means you are the issuer. And I invest.
Okay.
And I invest. I become the holder or the investor. And you, being the issuer, you will pay me the coupon rate of interest. So mostly, it is a long-term source of funding available. It's an external funding. You can go to the market, issue bonds, and get your money. But bonds can be, bonds are just like shares. It can be traded. You know, now I borrow, I have invested money in your company, and you have issued me a bond. Tomorrow morning, I can take it to the market and sell it to another person. Like the shares.
Oh, okay.
Like the shares. It is tradable. But to all to happen, the bonds can be only issued by a listed company like shares.
Okay.
So the shareholders, they have an equity stake. In other words, they have an ownership stake. Whereas the bondholders, they have a creditor stake or a liability stake, a creditor stake. They are never the owners. That is the difference. So as I said at the beginning, debt capital is never the owner. The difference between shareholders and the bonds in the market is bond gives you a creditor stake, equity gives you a ownership stake. And the bonds definitely have a redemption period, 10 years, 15 years, whatever it may be. But shares, no redemption period, particularly the ordinary shares or the equity shares, no redemption period, and it will be there forever.
Okay.
So that is what a bond is. Then we have something called commercial paper. Now this is a very interesting one. Commercial paper. Commercial paper is generally the large profit-making big corporations. They issue a bond or kind of a commercial paper, and they raise money in the market for a short period. Right? Normally, it's about maximum 9 months, less than 1 year. It can be for 1 month, 2 months, 3 months, maximum time. So it's generally commercial papers are always short term. Right? It can be.
How do they raise money based on a
Yeah, they give
paper? How do they do that?
It's like you know, they advertise on papers saying that they want to raise 100 billion, for example. Right? They go to the market and they will issue maybe 10,000 notes, 10,000 commercial paper. So you want to invest 100,000. So you will take 10 of those commercial paper and give them money. And in 3 months time, they will pay you with interest or whatever it may be.
Oh, they pay you interest. So your gain will be the interest.
Interest, or it can be traded, and you can sell it. You may buy it at 10,000. Maybe you can sell it at 10,100, for example. Because the company is doing so well.
Okay.
Company doing so well. You may buy it at 9,500, sell it at 9,700, like that. So it can be traded any time before their maturity date. On the maturity, the company, whoever who has the bond, now I bought it, I sold it to you, you have sold it to another party. Say end of September, when it comes to the maturity, that party will get that money, whatever the money, that value.
Okay.
So that is what it is. So it's essentially a short-term instrument. So we came across two short-term things: money market and the commercial paper. Commercial paper. Then
well, they are both debt finance.
All debt finance. All what I'm talking is debt finance. Yes. Today only we are talking about debt finance. So I want to talk about who are the players in the capital market. There are three types of players in the capital market. One is the issuer. Issuer is the people who wants to borrow money. Right? That is the companies can be issuing money. And mostly bonds are issued by the governments. You remember, you would have seen treasury bonds. Treasury bonds. That is the government is issuing bonds and raising money from the public. The banks will issue bonds and raise money. The big corporations will issue and money. So most of it is the government which raises money to the bond market through the treasury bonds. Then we have some people called underwriters. Underwriters are generally, they are the people who are facilitating the bond issue. Like they are people with knowledge, they are the people with some knowledge, so they will facilitate, they will tell you at what is price you can come out with the bond, and these are the terms and conditions, all that. I mean, they are the experts in the market. Then the purchasers. Purchasers are the people who buy these bonds. You and me. You and me. Most of the bonds are bought by big institutions, like the pension companies and all that. They buy the bond. But even you, as a rich individual, you can buy bond. And even the governments buy bonds. Government buy bonds in other countries. Right? Other countries. Now, for example, if you look at USA, Japan have bought a lot of their bonds. US owes a lot of money to Japan. I think US owes a lot of money to China.
China.
Yeah. The outgoing governor of our central bank, he went and invested some money on Greece bonds in Greek territory in Greece. He went and invested some money, and that was a big loss. So there is a corruption charge against him. So surely the new government will probe all those things because they believe that he was up to some mischief. So the purchasers can be anyone. That can be governments borrowing money, investing in the foreign country. So they are the players, the three types of players. So I want to discuss a little about the underwriters. Who are these underwriters in the market? Right. So this is basically they are investment banks and other financial institutions. They basically help the issuer to sell the bonds in the market. So you are a company, you want to raise 100 million, you will go to an underwriter. Underwriter will tell you what time is good to come out to the market and all that. And they will do the preparation of the prospectus and all that. Right? And they can place the bonds with specific investors. You know, without going to all the people in the market, they select particular good investors who has money, who wants to invest, and they will tell, this Shepito's company is coming out with a bond, and here, look here, we are recommending you buy it. So, or they can go to the market more widely, open market. So, when you go to restricted people, it is called a placement, or otherwise they can go to the market. Right? Alternatively, under a medium to note, issuer can issue debts on a regular basis. So, continuously you are issuing the bond. Right? Every 3 months you are issuing kind of a bond. And that also can happen. So, most of the governments, that's what they do it. Every 6 months, I suppose they issue bonds and get some money. That is one way they try to control the inflation also. They take the money back to the back out of circulation by offering the treasury bonds and all that kind of thing. So that's to a medium note program. So every 3 months, every 2 months, you go on issuing bond. So now I want to discuss the procedure for issuing bonds in the market. So the London Stock Exchange basically is the criteria. There are two processes. One, what we call the listing. So if you want to issue bonds, first of all, you must apply for a listing. Without becoming a listed company, you can't issue bonds to the market. So admission to the official listing is controlled by what we call the UKLA, UK Listing Agency. So they have to satisfy certain requirements and disclose a standard. And normally, if everything is okay, within 3 days, you should get the listing. But to get that, you probably want to appoint some advisors with experience, because you may not have the experience. So appoint right people, they will be able to do it for you. And within about 3 days, if everything goes well, you should get your listing. That is the process stage 1. Second stage is admission. Now, once you get listed, in 2010, these people have introduced something called order book for retail bar. That is basically online trading facility. Online. So the investor can go to the online on the computer, they can buy it and they can sell it. Right? So the moment you list it, you must get into that order book for retail or ORB. So that is what that is why we call it admission. So to get admission, we have to comply with certain documentation. So generally about 11 days prior to the admission date, you must submit your all documents. So documents what is required is the prospectus, the pricing document, board minute, and a market maker confirmation. So market maker is the other player in this market. Market player is like a marriage maker. No, he's like a broker. He can support you, and he will tell you the opening price for the security, etc. So remember there are 2 stages. One is the listing stage. Second one is the admission stage. Right. So I want to talk about
the market.
Market maker.
The market maker, could that be an underwriter?
Yeah, could be underwriter, even could be the company. That's what I'm coming to the next slide, Chetu. Market maker. Right. Market maker. I'm going to come to that one. So the market maker, so as I said, for the ORB, it's a requirement that we have at least one registered market maker. So they are the experts. They will ensure that all instruments are tradable and they have a price available throughout the day. So market maker is like a continuous man who will tell the price at 11 o'clock, who will tell the price at 12 o'clock. Because the market prices are changing every 15 minutes. Right? So issuer itself can act as the market maker. You being the company, you can be the market maker. You will put one of your representatives and he will be ensuring that the prices are available throughout the day. Or we could engage the services of a third party. Of course, the market makers must be members of the London Stock Exchange and they should be authorized to deal it. So, market maker is required to quote two-way price. That is, if you are going to buy bonds, what is the price? If you are going to sell bonds, what is the price? And also probably a minimum volume. Because you can't buy bonds, this 1 bond, 2 bonds, that kind of a thing. Maybe 100 bonds, maybe 1,000 bonds. Now in Sri Lanka Stock Exchange, if you want to buy shares, the minimum number of shares what you can buy is 50. So like that, right? So there will be some minimum quantity. That is what a market maker's job is. Now I want to talk about the international debt finance. International debt finance. So we know that today the large companies, particularly the big companies, they can borrow either locally or internationally. Most of the companies can borrow it. So the main reason to borrow in foreign currency is to look after a foreign investment project or a foreign subsidiary. Say you are in USA, you want to go to UK and invest. So a good thing is to borrow in UK in sterling pound. Because that way you can reduce your exchange currency risk. So it provides a natural hedge against currency fluctuation. And you can service the loan because you are borrowing there, right? So you are borrowing there, and therefore you can your cash flows will be in UK. From that you can repay the loan. So it's a good thing if you are going for foreign investments to borrow international market. But all these things are available only for large companies, unfortunately. You and I, if we go to the international market, they will chase us out. Yeah. Then the choice of currency for debt finance. So, most of the developed countries like USA, UK, Germany, they can choose what currency they prefer to both bank loans and bonds. You know, they can demand, they can say, I want to borrow it in dollar, I want to borrow it in sterling, I want to borrow it in euro. So in the developed countries, they have that option. But in developing countries, mostly they will have to borrow it in international currencies, and mostly it's either dollar, euro or sterling. So developed countries, they can choose, but developing countries, they don't have too much of a choosing option. They will have to borrow in particular currency that is available in the market.
Okay.
Now I come to a very interesting one, that is called Eurobonds. Eurobond. Now Eurobonds are bonds issued on international capital markets. Like the New York capital market, the London Stock Exchange, they are issued only by international capital markets. Not that every local stock exchange can issue it. But the important thing that I want to remember is, even though it is called Eurobonds, it can be in dollars, it can be in sterling, it can be on anything. Now that's a very important one. Right? So the examiner is sure to test you on this area. Because when you say Eurobond, you think it must be euros. No, not necessary. It can be denominated in any currency. So Eurobonds could be listed in the domestic currency stock exchange. Now it can be listed in the Sri Lanka Stock Exchange, but we cannot trade it through the local exchange. We have to go to the international trade exchange, either to buy or to sell. They are usually bearer bonds. Bearer bonds means no name. No name. I buy it, I can transfer it to you, you will transfer it to another person. And whoever who is holding that on the date of the interest will get interest gross interest without tax deduction. Now that is what the difference in a Eurobond. Eurobond is essentially a bearer bond, no name. So because of that, no taxes are deducted, because who is going to pay the tax? No one is going to, because no one knows, right? It can be a certainly an undefined person for purpose. So this is in contrast with domestic bonds. Domestic bonds are both listed and traded on the local exchange. So Eurobonds are listed in the local exchange but cannot be traded.
Okay.
Then domestic bonds are registered to a name holder. It's not a bearer bond. It is for Shetu or Kumar Fernando or whatever it is. Normally they pay interest biannual. Net of interest. The Eurobonds pay gross of interest. They don't deduct tax. They don't deduct tax. But the local bonds, they pay net of the interest. That is what we call withholding interest tax. And Euro markets are in an international market, which is a self-regulated offshore market. It is the international market which is in offshore, right? So it is promoted by the Capital Market Association. They set the rules and the processing of transactions and the payment of commissions. Yeah. So that is what euro is doing. Right. So that's basically a euro bond. So euro bond is a very famous examiner's topic because most of the people, even I thought for a moment earlier, when you say euro bonds, it must be euro denominated. Euro denominated. But now I know it's not euro denominated because they have been telling this continuously. So we know it is no longer euro denominated. Yeah? So that is what we call a euro bond. Right. So, yeah, that's it. So
would that mean the Eurobond will be it's more expensive than the domestic one?
Eurobonds are generally cheaper because, locally sometimes the things can be very expensive. And that is why the people go to the local market, the Eurobond market. Eurobonds are generally, I would imagine it to be very cheap.
Okay.
Yeah. Just give me a minute, Setu.
Okay.
Right, okay. Ready? Right. So now we are going to look at the decisions that the people will have to decide, the financial strategies or the board of directors. So on the debt, they have to make actually 3 decisions. One, they have to decide whether they want the interest to be fixed or floating. You can borrow money on fixed interest rate. You can borrow money on variable interest rate. You can borrow money on long term. You can borrow money on short term. You can borrow money on domestic. You can borrow money on foreign currency. So there are 3 key decisions you want to make it. Whether to borrow interest fixed or variable, whether to borrow short or long term, whether to borrow domestic or foreign currency. So these are some of the decisions that you will have to look at. So I'm going to talk about something called interest rate risk. Interest rate risk. What is this? What is this? So when you borrow money, you can borrow, as I said, either on variable interest rate or fixed interest rate. Right. So whatever the way we borrow, there's a risk. There's a risk. The risk arises due to change in interest rates. Change in interest rate. So if you have any assets or liabilities where you are going to pay interest or receive interest, you are obviously subject to this interest rate risk. Now companies mostly borrow money. So they are subject to the interest risk for the payment of interest. But you and I, sometimes we go and invest money. And then when the interest rates come down, that's a risk for us. So a couple of weeks back, I met one of my aunts. She's an old lady. So she was very depressed and desperate and all. I asked why. She said that, when I invested the money, I got so much as interest. And I was getting so much. And that was, I was able to look after my medical expenses and all that. But look here, this governor fellow, the president of the country, has messed it up. They have reduced the interest rate, which is a good thing for the country, but poor lady is suffering. Now that's a risk for her. Yeah. That's a risk. So the companies mostly borrow, but there can be particularly the banks, they can have both ways. Banks, because they borrow and they lend it. So interest rates can have an impact upon their profitability, on their rate. Particularly the non-financial entity like the companies, they probably have more interest-bearing liabilities than interest-bearing assets, because generally they don't have too much of money to invest. They invest in the business. But the banks, they invest with the lenders, the borrowers. Right. So mostly the non-financial entities, they borrow overdraft, they borrow bank loans, they issue bonds or debentures. Debentures is also another form of bonds kind of a thing. Right? It's a bond, it's like a fixed interest, a kind of a long-term loan. So generally, on the bank loans and overdraft, interest is normally payable at a variable rate. Right? Generally, most of the time, the bank loans or overdraft are paid at a variable rate. So that is the normal thing what we will see. So the variable rate is normally fixed LIBOR plus margin. What is LIBOR? London Interbank Offer Rate. London Interbank Offer Rate. What is London Interbank Offer Rate? The best banks borrow from one bank to the other, and that rate is what we call the LIBOR. And normally it is, so if you and I want to borrow a variable, they will say LIBOR, which is varying every day, plus so many margin. Now they call basis points. LIBOR plus basis point. Normally 100 basis points is 1%. So if they say LIBOR plus, if they say LIBOR plus 200 basis points, we know if the LIBOR is, shall we say 5% today, it is 5% plus 2%, 7%. Correct? If they say LIBOR plus 50 points, then it is 5% plus 0.5, 5.5.
0.5.
So 100 LIBOR point, 100 basis point is 1%. So the normally the variable is fixed, LIBOR plus so many basis points. So they might say LIBOR plus 2%, or they might say LIBOR plus 200 basis points, or LIBOR plus 500 basis points, LIBOR plus 100 basis points. So remember, 100 basis point is 1%. Normally the interest on bonds, debentures and loan stocks, that is what you issue to the market, is generally fixed rates. You don't give LIBOR rate, generally you go fixed rate, 3%, 6%, and this rate we call the coupon rate.
We call what?
Coupon
rate. Okay.
Coupon rate. Normally the language we use is the coupon rate. Coupon rate. So that is basically what you need to know about this interest rate and the risk involved in it. So we are going to move on that one. So exposure to interest rate. Now what do you think? Now you can borrow, say imagine you are a company, you can borrow fixed or variable. Right? So what do you think where you are exposed? Will you borrow, if you borrow fixed, will you be exposed? Will you borrow variable, will you be exposed? Exposed means but the risk.
Yeah.
What will you think?
Well, it's either way, because if you borrow fixed and then the interest rates go down.
Very good. Yeah. You're right. But the variable, the floating, the variable, you know, it's very obvious. The rates goes up, you are in trouble.
Yeah.
Right? It is very obvious. It's very directly having an impact on the cash flow. Fixed one, it is not very direct. It is somewhat indirect, because you are borrowing at 10%, you are committed to 10%, but your competitor is borrowing at LIBOR plus 2%, and his rate is 8%. So it is going to have an indirect impact on you. So the floating rate exposure is somewhat direct and very obvious, but the fixed rate impact may not be that obvious, but surely it can have an impact upon you. So the interest rate, either way, as you can see, either way, it can have an impact upon you. So you are exposed to interest rate risk all the time. Then we have the refinancing. What is refinancing? Now when you take a loan, after 3 years, 4 years, 5 years, you may have to settle that loan and go for a new loan. Because you may want to continue the loan, but it is coming for repayment, and you have to repay, and probably you have to. So at that time, the banker may say, sorry, we are not going to give you a new loan. So your loan application, if it is approved, it's all right. If it is not approved, it's a risk. So the risk is loans may not be refinanced or not refinanced at the same interest rate. Okay, they will say, yes, we will extend the loan, but not at 6%, but at 8%. So that's a risk for you. That's a risk for you. It could be due to many reasons. The lenders may be unwilling to lend or only prepared to lend it at high rates. Right? They don't like you. They don't want you. So I worked in a company that bank was all the time increasing the rates for me. So later on, I asked, what the hell you are increasing the rate for me? He said that I don't want your business. Okay,
well, okay.
They said, I don't want your business because, I don't like your people in the company and we don't want your business. So because of that, to discourage us, they were always increasing the rate. Right? They are very good friends of mine. They are good friends of mine, but they didn't like the people there. So because of that, they were raising the rates all the time. And the same back, when I went into another company, they were prepared to cooperate with me. So the banks have their various moods and their tools and attitudes and all that.
Yeah.
Maybe your credit rating has come down, right? Because earlier you were AAA, now you are a triple B company. So because of that, it's more risky. And therefore, they don't want to lend it for you. That can be a reason. Maybe the company wants refinancing quickly because your one bank has refused to give you anything. So suddenly you want to go to another bank. Now you didn't have time to plan. You are in real crisis. And when you go like that, you are desperate. You may not be able to get the best thing. Right? And that's a risk. And that's a risk because you have no choice. Like beggars have no choice. You have no choice. You have to decide very fast because your time is coming up. So last 2 weeks back, we had a similar situation. We were trying to sell one of our properties because that property was almost under a mortgage, and the bank has given us time till 31st December. So the 31st December was nearing. We found a buyer. The company found a buyer, but surely not the best person to whom we want to sell it. Right? Because we didn't like it. But what to do? Because we can't be choosy, we can't be selective. So we had to sell it. So yesterday also my managing director was telling me, if I had any other option, I would have sold it to any other party, but not to this fellow. But what to do? I had to sell it. So sometimes you may get into such a desperate situation, you don't have any option but to go along with this kind of a thing. So that can be a kind of a scenario. Then the use of longer term. So that is the way to reduce the risk. Don't go for short term thing, go for long term. If you take a loan for 10 years, then you have no refinance, and it's at least for next 10 years. Yeah? If you take a loan for 2 years, every 2 years you have the risk. So look, sometimes in the strategic case study you might have that 2017 your loan is coming for repayment. Now there is always a risk of refinance. Can you find money? If you can't find money, you may get into a kind of a crisis. So that is an issue that you may have to want in. Right? Then a short-term debt has to be regularly repaid, renegotiated, and there can be always the risk of refinance. So, if you want a loan for 10 years, try and negotiate a loan for 10 years without trying to go for 2 years and 3 years time. But the disadvantage is the other side of it. When you are committed for 10 years, if the rates come down, you are still committed for 10 years, you can't get away.
Yeah.
It's like a marriage. Once you get married to that particular person, you have to live with him whether you like it or not. So,
yeah.
that risk is there. But you can't be changing the husbands or wives every 2 years. So we have to go with that long-term arrangement. But nowadays, today in the new world, we see the wives and husbands also changing like short-term finance every 1 year, 2 years. I have uncle of mine, he's a photographer. He says when the couple comes to book him, he takes the full money up front. So I asked him why. Because he says sometimes they marry, and even before the album is prepared, they have divorced. So because of that, so he doesn't want to take any risk. So he takes all the money up front. When the couple comes before the marriage, he takes all the money. So the world is thinking in different ways. Everything is short term. Changing. Yeah. Then I told you there are a couple of risks that you were talking about. One is the interest rate, other one is the currency risk, right? So when you borrow money, particularly if you borrow foreign money, you have the risk. Right? So if you are having any assets and liability, that is if you have borrowed money or if you have invested money in a foreign currency, with the exchange fluctuation, you will have that fund. And if you are going to have any income or expenditure in a foreign currency, you have to pay interest. If you are going to receive interest, surely you are going to have that exchange risk all the time. Even the other part is very interesting. Even if your company is totally local finance, still you may be subject to foreign exchange risk because your competitor may be borrowing foreign and buying and getting cheap finance, and he may be able to reduce the selling price, and that can have an impact, and that is what we call economic risk. It's not a direct risk, but you know, you're totally innocent, you're not doing anything, but your competitor is borrowing at a cheaper rate, and he can give you that, therefore it is affecting you. So the currency risk can affect our interest rates and all that, finally what we have to pay. So I remember 2 years back, 3 years back, or 5 years back, a lot of my colleagues in the business world, they started borrowing lot of money from Europe countries because the rates were very low. European interest rates are very low compared to the local company, local bank. I was borrowing all the time local. So they were telling me that you are a real fool. Why don't you go to the foreign market and borrow? I did not want to do it because I always thought it can be a very risky one for me. And particularly I was working in a government institution, so I was more scared because if anything happens, I also will be subject to a lot of political victimization. So finally, I am told right because my home currency has depreciated so much. Now, when you want to pay a foreign interest, you are paying almost double of what I am paying locally.
Double.
Yeah, because the currency has depreciated. So recently, I met one of those friends, you know, who told me, who said I'm a fool. So I said, now, who is the fool?
Yeah.
Who is the fool? So you have to have foresight. You can't be thinking only in terms of today's interest rate. You must think of the currency rate. Because later on we will learn on the interest rate parity theory, higher the interest rate of a country, that country currency depreciates. So we have to remember all those things. So this is what we call a currency risk, I say to. Then I want to talk about the currency swaps and the interest rate. This is earlier it was in the PP syllabus, but now it has moved into the FT syllabus. So what is a swap? Swap is basically a contract to exchange payment of some sort in the future. Now it is something like this. You have borrowed some money. I have borrowed some money. Right? You have borrowed some money in America. I have borrowed some money in Sri Lanka. But you want to do some business in Sri Lanka. But if you come to Sri Lanka to borrow money, you will find it extremely difficult because you are not a Sri Lankan. But I can borrow money in Sri Lanka because I am a Sri Lankan. The banks have confidence in me. Similarly, if I try to borrow in America, I can't borrow it at favorable terms because I am not American. So what you do is you borrow in America and you tell me, Kumar, you use that money to do the business in America. You use the business in America and you settle American loan on behalf of me. Behalf of you. And I have taken a loan on behalf of you. You are coming to Sri Lanka and doing the business and you are going to settle. But the legal liability for the American loan is with you, for the local loan is with me. But we have swapped it, we have exchanged it. This is simply a swap. This is simply a swap, right? Your legal obligations remain as it is to the original borrower, original lender. But we can swap it. We have come to an agreement. That is an agreement between us. It's a contract between us. I'm going to pay what you pay, and you are going to pay what I have borrowed.
Okay.
So
basically, it's just that the banks are kept out of it. It's just both of us. So it's just the logistics about the money and payment will just be both of us.
A good question you asked me.
Yes.
Yeah, actually what is in real practice what happens is we get the bank cost involved. Bank in the sense not your bank, not their bank, but but we probably will get an intermediate to intervene between us, because you and I, one party is definitely going to lose on this transaction, the other party is going to gain on the transaction. So that party can try to default it all the time. So to minimize the default, what we do is we try to get a bank as the intermediary. You might want to default me, I might want to default you. But when the bank is sitting in between us, we will not try to default you.
Okay.
And generally these swaps are done between highly reputed people, the people who will stand for their reputation. Even if they are going to make the loss, they will honor their contract. Yeah? So it can happen on the interest rate, it can happen on the currency. Right? The interest rate, what happens is, you have borrowed it on fixed, for example. Right? You have borrowed a loan on fixed, and I have borrowed a loan on variable. Right? Now my obligation is to pay the variable interest. Your obligation is to pay the fixed interest. But now you want a variable loan. Why? Because you think the interest rates are going to come down. So one option you have is you can go to the bank and say, hey, I want to settle this fixed loan and I want to get a variable loan. Bank will say, very sorry, we can't do that one, because you entered into a contract to take a fixed loan from us, and therefore we have borrowed fixed. We have borrowed fixed to give you the loan, and now we can't change it. If you want to change it, we want to charge a penalty. So you are helpless, right? But you are determined to get a variable loan. So now you find me, I'm a partner, I'm on the other side of it. I'm looking for a fixed loan. So what we discuss is, what we agreed is, okay, you will say, whatever you are going to pay to your bank, right? You are going to pay the fixed amount to the bank. I'm going to give you that amount. I'm going to give you that amount. So whatever, say you pay 10%, I'll give you the 10% back. And whatever I am paying to my bank, the variable, you will give it to me. So effectively what has happened is, earlier you were fixed, now effectively you have become variable. Right? And I, who was variable, have become fixed now.
Fixed, yeah.
So that is what the swap contract is going to do it. So, and particularly, as I said, currency swaps are basically because you in America, you are in a better position to borrow money in America than me at a cheaper rate. Because if I try to borrow in America, they will charge a higher rate. Similarly, if you try to borrow in Sri Lanka, they will charge a higher rate from you because you are American. So we can take advantage of our own nationality. You can borrow it at cheaper rate, and I take advantage of that one. And I borrow it at cheaper rate in Sri Lanka, and you take advantage of that one. That is what we call a currency swap. But remember, the original obligation remains with the original borrower and the lender.
Yeah.
That is what a swap is going to be. That's what a swap is going to be. So I want to look at this interest rate swaps now. So interest rate swap is basically an agreement between two parties, right? You have a floating stream of interest, and I have a fixed stream of interest, and we try to exchange it. That is what. You are paying floating, I'm paying fixed, and we exchange it. So whatever you are paying floating, I will reimburse it to you. Whatever I am paying fixed, you will reimburse it to me. So normally that is a good hedging technique, and it can cover any period, even up to about 30 years it can be covered up. So that way now why do you want, now you have borrowed it fixed, why do you want to convert it into a variable? Because you think the interest rates are going to come down. So you want to take advantage of that one. On the other hand, I'm thinking in the opposite direction. I have taken it on fixed I have taken it on variable, and I think the rates are going to go up. So I want to fix it. Right? So because of that, I like that.
Yeah.
So you have to find two people thinking in two different ways. So the two companies involved are called counterparts. So you and me, if we come to a direct agreement, we are counterparts. You are one counterpart and the counterpart. But normally, as you rightly said, banks, they become very specialized in this area. So the bank can act as an intermediary between two of us. Of course, the banks will not do anything, nothing. They will charge a fee. They'll charge a fee. And sometimes it so happens the bank will become the counterpart for you and will become the counterpart for me. Now I have borrowed fixed. So the bank will work out with me on a variable. Right? Banker will work out because I have taken a fixed loan. So banker will say, okay, whatever you are going to pay fixed, the bank will reimburse it to me. And whatever bank is going to pay variable, I will reimburse it to the bank. But at the same time they enter with you another contract, opposite direction. My fixed they convert it into variable, right? Your variable they will convert it into fixed. So the banks will enter into many contracts like that. Many candidates will reduce their risk and it will accommodate both of us our need. So rather than we two getting together, right? It is a bank working with me isolated, bank working with you isolated. So that way the risk of a default is very much minimized.
Yeah, because someone is going to lose out anyway.
The
interest rate is going to lose out and it doesn't.
Yeah, you're right.
Yeah.
One party is always going to lose out on this one. So always there's a possibility of one party defaulting. So I want to show this diagram. Now, this is the diagram that I want you to understand it very carefully. Now, this is company called D. The D. So they get a 1 million loan at fixed rates. So they have borrowed it from, whatever the bank, and that is the original lender. So they have an agreement to pay that 1 million at fixed rate. Right? So D has borrowed money and D is under obligation to pay that 1 million interest, whatever the interest, at the fixed rate. Similarly, another company called E has got a 1 million loan at floating rate, variable rate. Now, they also have an obligation to pay to the original lender 1 million, floating rate. So, their interest is floating. Now, these two will remain as it is for next 25 years if the loan is for 25 years. This legal obligation is not going to change. So, how will the swap happening? Swap happening is basically D, right? D is going to pay whatever that E pays. So E pays floating rate of interest to the original lender. So whatever, say let's assume E pays $70,000 at floating rate. That 70,000 D will pay back to E. Back to E. So he will have a 70,000 outflow to bank. So for example, I'm taking a 70,000 just as an example. 70,000 is made up of LIBOR plus 2%. So let's assume LIBOR is 50,000 and the 2%, and with that it is 70,000. So these people will have to pay 70,000 to their bank. They will pay to the 70,000, and whatever the 70,000 it is paid, these people will pay to D. They will pay the 70,000. So they will pay 70,000 money and they will get 70,000 money. No problem. Now what is going to happen? Now D would have borrowed on the fixed rate and maybe 6% interest. So they will have to pay 60,000 to the bank. So they will, his contract remains to pay 60,000. Now what happened? Right. Next thing what is going to happen is whatever D receives, right, D will receive fixed interest from me. So whatever D pays, this man will give him back.
Okay.
So D will get 60,000. So now let's look at from D's angle what is happening. D paid 60,000. D paid 60,000 and D got 60,000 from me. Right?
Wait, I'm confused. 1 minute. Can we go back 1 minute?
Okay, yeah. Okay.
So D's fixed rate interest is 60,000.
D's fixed rate interest is 60,000. So D has to pay to his bank 60,000. Right?
Yes.
So whatever D pays, E will reimburse it back to him. So D pays 60,000 to the bank, 60,000 to the bank, and E will give that 60,000. So his cash flow is balancing. But the D will have to pay whatever E is paying. E is paying 70,000 variable. So ultimately, what is the cost for D? Ultimately, what is the cost?
10,000.
No.
10,000.
Is it 10 or what is that? Because they paid 60, they got 60. Yeah?
Yes.
And they are paying 70,000. Yeah? Right? They paid 60. D paid 60 to the bank, and D got from E the 60,000, whatever he paid, and D is interest because he has to pay 70,000. So D is paying E 70,000. So the net cost to D is 70,000.
Oh yes, 70,000. Yeah.
70,000. Now, if not for the swap, he would have paid only 60. He would have paid the bank 60,000, and that's the end of it, isn't it? Now look at from E's angle.
Yes.
From E's angle, what happened? Right? E has to pay 70,000 to the bank. Right? So he will pay to the bank 70,000, and D will give them 70,000. D is paying 70,000.
Yes.
Right? 70,000. But so that is okay. But E has to pay the D's interest 60,000. So what is the cost? What is the cost to E? What is the cost?
60,000.
60,000. So what has happened? If not for the swap, D would have been paying 70. But because of the swap, E is paying only 60. So he is saving 10,000. He is saving 10,000. But D, because of the contract, because of the swap, he is paying more now. Because if not for the contract, he would have paid 60, but he is paying 70,000. So your gain is my loss. Your gain is my loss. So this is what happens in a swap all the time. So what you have to remember is your original commitment remains as it is. It doesn't change. What is changing is basically whatever you are paying, I'm going to reimburse. Whatever I'm paying, you are going to reimburse.
Yeah.
Now you can see why D entered into a contract. Because D was paying fixed, right? D was paying fixed, and D would have thought that the interest rates are coming down, and that is why we would have entered onto this. But to see the interest rates have gone up because it is 70,000, 5 plus 2, right? So this is what is going to happen. So maybe this year it is like that. Next year it can be the opposite. Next year the LIBOR can come down to 4, and 4 plus 2 maybe 60, right? Well, and maybe 3 plus 2 is 50,000. So it can change all the time. And this is what the swap is. So your original obligation to the lender remains as it is. So this diagram, I would like you to think about it very carefully.
Okay.
So this is the most important diagram, I would think, that you need to think about it very carefully, how it is. But I mean, nothing big in it. Simply, what you need to know is the original liabilities of the two parties remains as it is. What is happening is, whatever interest you are going to pay, I am going to reimburse. Whatever interest I am going to pay, you are going to reimburse. That's what is going to happen. So that is what the interest rate swap is. So you may be asked to put up a diagram like that, even in the OT question. So you must know how it is coming. Right.
Okay.
So there is something, because the banks are involved in it. Banks generally arrange the swap. So they will have something called a ask rate and a bid rate. Right? Ask rate is the rate at which the bank is willing to receive the fixed interest cash flow stream. So the ask rate, maybe the bank will say, I want to get 4%, for example. But the bid rate is the rate which the bank is willing to give it back. So maybe 6%, for example. Right? So that difference is what they call their profit margin.
Okay.
Profit margin. And normally it's not a lot of money. It's just about 2 basis points. So it's not a lot of money. It's about 0.2%. So it's that is what the bank will make it. So bank will, so we will look at some examples when you're looking at some of the questions.
Okay.
So because of the bank's involvement, the advantage is the question of risk case or default is very minimal.
Then so this is a rate at which the bank is willing to pay a fixed interest cash.
That's correct.
Stream. Okay.
Exactly. Okay. Yeah, right. Because that is what the banks makes a profit. So what are the advantages? Advantages, it's definitely, without changing the borrowing. Now you borrowed money from that particular bank. I borrowed money from the bank. Without changing that underlying borrowing, that is the main borrowing, we can still manage our interest rate raise. That is what the advantage. Because we didn't go to the bank and ask the bank to cancel by fixed and give me a variable. No, that remains as it is, but with you I have agreed and we can do it. So it allows you to take advantage of expected increases. That is according to your expectation. You think the interest rates are going to go up and therefore you would want to go for a fixed one. I think the interest rates are going to come down. So based on my expectation, based on your expectation, we can do it. And because it is happening, your fixed rate instruments, your fixed rate deposits will have its value, because otherwise the fixed rate interest rate instruments can go down in value because you have a liability, and if the liability rates are going to go up, it will not have a market value. But because you have hedged it, now your fixed rate is going to be very secure, so because of that you will be protected. And you can be using it to borrow cheaper finance. So this is something what we call comparative advantage between inside the group. If you have two companies, they can take advantage. I'm going to work out example next week to show you how it is going to work. The comparative advantage. So this was in the P tree earlier, but now all that has come to the F tree now. So these are the new things that have come to the F tree. So what are the disadvantages? Disadvantages are basically where you will put your head down. Right? Interest rates will change in the future and the entity may be locked into an unfavorable rate. You went and entered into a swap and you say, my God, the interest rates are all the time going up. And you will think, why the hell did I go and enter into this? If I did not enter, I would have just paid my interest rates and just kept quiet. But now I'm paying unnecessarily to say to unwanted. So that can happen. Right? You may find it very difficult to find a swapping partner, because you have to find partners who are thinking in two different directions. One who is thinking it's going up, the other one who is thinking it's going to come down. And also the default risk. Also the default risk. So little bit more to do. I have not completed this. There are a few things, but I basically covered up the big area. Another 5 minutes probably I will need